We're live.
Okay, hello everybody, Simon Dixon here, doing a little bit out of my normal planned schedule, but the news is actually worth it. So the IMF actually dropped a ginormous bomb on us. I'm going to go through and give my commentary on exactly what the IMF announced yesterday to make sure everybody's up to date on what's actually happening. I don't really know where to start on this one because it was only last Wednesday that we gave a video on what the IMF is up to and how that's going to lead to a monetary renegotiation, Bretton Woods style. And then lo and behold, the IMF launched on their own website, their own video, that a Bretton Woods, calling for a Bretton Woods style monetary renegotiation. Now, to most people, that sounds like a bunch of jargon and a load of stuff. To my subscribers, you will be very, very prepared for this, and you would have been lining yourself up expecting this to come. But one of the questions in the AMA that I did last Wednesday on my YouTube video, Simon Dixon, was when will this monetary renegotiation happen? And I think I answered that it's laying the foundation now. I'd expect to see it within the next 3 years. What I didn't expect would be an announcement in the next couple of days after releasing that video. So those of you that are new, what we're going to do is we're going to play that video and we're going to give some live commentary on exactly what the implications are, exactly what I think the announcement means, and more importantly, we'll be covering in future videos exactly how you as an investor or even just a person with a regular income might want to start positioning yourself for what comes next. So we're going to jump straight into that. I'm not going to assume that everybody actually knows me. We had over a couple of videos back when we talked about some of these implications. We had over 310,000 views on one of the videos. So just before I jump into this, I want to thank everybody that's been following me over the years that has taken the videos that used to get a few thousand views to over getting 300,000 views. That's because of you. So I want to thank everybody that's been following this all along, that's prepared for what's coming next. And thank you for sharing, liking all these videos. It's all working. And this message is getting out to a much, much wider audience so that people can be prepared. And exactly what happened with the IMF is exactly what inspires me to create more videos like this. So if you could like this video, if you could share this video, then we can try and get as many views as we've got in previous videos when YouTube starts sending the love and it starts ranking it for our other videos. Because this is such a bomb that was dropped, that is such an important news that many people might drift over this news. It might fall into, being focused on lockdowns and stuff like this, because many of these big monetary renegotiations, for example, the 1913 Federal Reserve Act, was actually implemented the day before Christmas when nobody was focusing on the news so that they could pass it through. But this one was a big announcement, so we're going to give that live commentary. Now, I don't want to assume that everyone knows this, so I want to give a bit of background just so that we can actually go through some of the trends. And then I'm going to move over to the screen share. I'm not doing an AMA today, but you can join me next Wednesday, as usual, when I do my weekly AMA by subscribing to my video, Simon Dixon, on YouTube. Hit that bell symbol, you'll get a notification, and then we can dig deep into your questions. Today, we're just going to be focusing on the commentary. But to give a bit of background, I released a video just a couple of days ago where I went through an old article that I published on my blog in 2009 on the International Monetary Fund, the World Bank, special drawing rights, and the flow of funds. In 2011, I published a video called The Great Depression of the 2020s, where I was talking about Keynesian, monetarism, and different schools of economics that would lead us to the economy that we are in today. After that, I spoke at the very first Bitcoin conference in the world, and in 2016, I published the first video on central bank digital currencies and how it would be used to have radical monetary reform. In 2010, I published the very first book in the world that included Bitcoin and talked about some of these trends. And it was called Bank to the Future, Protect Your Future Before Governments Go Bust. In 2019, I published a video and called it How Bitcoin Could Become a World Reserve Currency by 2020. Not saying that that will happen this year, but talking about a set of scenarios that could happen in order to lead to such an event. And really, the playbook that was discussed in that is really coming to fruition with this IMF announcement. And finally, I've been in the next few weeks on retirementplanb.com. I'll be releasing a 4-part video series on exactly how I will be investing during a monetary renegotiation, a Bretton Woods Nixon shock style moment like we are receiving today. But fortunately, it gives you enough time to actually prepare for that, because I'll be putting $1 million of my savings and showing how I would do it from scratch if I were starting today. So that's a bit of a background. So firstly, the big news, the headline on the IMF's website is that they are calling for a new Bretton Woods style moment. So what the hell is Bretton Woods? Well, to give a bit of background before we actually play that video, it was a moment in 1944 when the 44 people of world leaders were negotiating the future of money, and they moved from a gold standard to a fixed dollar exchange rate standard, where essentially gold was the basis for the dollar, and other currencies were pegged to the dollar. Now that was removed in 1971 with the Nixon shock and implemented over an extended few years. Prior to that, John Maynard Keynes was talking about the Bancor coin and how to introduce a new coin. And that brings us really where we are today, and this calling for a new Bretton Woods style moment. So what I'm going to do is I'm just going to dig deep into the IMF's website where we had the announcement and play the video and make sure that you're all up to date. And then I'll pause it every now and then to actually give some commentary on what I think this means for you and the implications. So I'm just going to try and figure out the technology, and hopefully everything works. And I've also got Azad online. He'll just let me know if anything's not working. But you should be seeing this video, and I'm just going to play that video, and hopefully you can see everything, and Azad will let me know if there's anything wrong. If not, we'll just carry on.
Reflecting on the dramatic change in the world over the last year, I paid a visit to Bretton Woods in New Hampshire, where 44 men signed our Articles of Agreement in 1944. Our founders faced two massive tasks: to deal with the immediate devastation caused by the war, and to lay the foundation for a more peaceful, more prosperous post-war world.
So firstly, that is exactly how it was sold to us. But what actually happened, if you go back to my article that I wrote in 2009, the World Bank and the IMF actually became a ginormous leech, pushing the debt-based Ponzi scheme that we moved towards, and really moving in 1971 to the full fiat-based debt standard. This was the removal of gold, which was the real start of the debt-based Ponzi scheme that we currently operate in.
At the conclusion of the conference, John Maynard Keynes captured the significance of international cooperation as hope for the world.
So it's important to understand that John Maynard Keynes was a socialist. He was an economist that believed that government should step in and fix the economy in times of low unemployment, because monetary policy, where central banks control interest rates and the money supply, doesn't actually work. So this was the beginning of a socialist movement. So you have two different schools of thoughts in economics, well, many different schools of thought, but two particular ones that believe that in bigger government. One is Marxism, which is where the government redistributes all the world, makes private ownership of property rights illegal so that everybody receives the same amount of money. It's a more drastic form of economics. But the other is socialism, where slowly but surely you move towards a communist style economy, but you do it in a very, very indirect way, through increasing taxes, gradually increasing debt. And Keynesian was a socialist, and so the Bretton Woods meeting was really the beginning of trying to introduce socialism into capitalist economies after the World War.
If we can continue, the brotherhood of men will have become more than a phrase, he said. As we look forward to welcoming Andorra as our 119th member, the work of the IMF is testament to the values of cooperation and solidarity on which a sisterhood and brotherhood of humanity is built.
So let me retranslate that. The IMF and the World Bank are an organization that uses money creation in order to issue loans backed by pretty much nothing, so that they can introduce debt with tied loans, as I talked about in previous videos, so that the money is created as debt, lent to countries that need greater support, like developing countries, and then the negotiation of those loans are tied back to having to spend that money in more developed countries, so that they end up with all the debt. The debt-based money ends up in the developing economy. I know that's quite a lot, but check out previous videos in that article in 2009 to understand what a leech on the economy and the world it actually ended up being.
Today, we face a new Bretton Woods moment.
So it's always fear-based, fear-driven events that always lead to these ginormous monetary renegotiations that lead to the gradual removal of privacies, rights, and liberties, using currency wars as the mechanism, which is more of a hidden war, and inflation, which is more of a hidden tax.
A pandemic that has already cost more than 1 million lives. An economic calamity that will make the world economy 4.4% smaller this year and strip an estimated 11 trillion of output by next year. And untold human desperation in the face of huge disruption, rising poverty for the first time in decades.
But then we've also got to look at who the beneficiaries of that 11 trillion are, because the 11 trillion has been replaced with central banks through quantitative easing borrowing the monies off the government. So the governments are going deeper and deeper and deeper and deeper into debt, while the central bank is essentially creating new money in order to purchase those. And now the governments have to factor in all this interest rates, and the interest rates on all these trillions are going to be at some stage equal the amount of tax that they collect. And it's rehypothecated through issuing more bonds, more bonds, more bonds in the debt capital markets.
Once again, we face two massive tasks: to fight the crisis today and build a better tomorrow. We know what action must be taken right now. A durable economic recovery is only possible if we beat the pandemic. Health measures must remain a priority. I urge you to support production and distribution of effective therapies and vaccines to ensure that all countries have access. I also urge you to continue support for work.
So what they're leading up to here is that they're leading up to the world's trying to take on their loans. They have an overdraft facility at the IMF where member states can actually go into those overdraft facilities. It can increase the level of indebtedness, and then they can tie that to rebuilding of infrastructure, and in this case, the movement out of vaccines, borrowed all on debt in somebody else's currency that will be tied to purchasing those vaccines from whoever actually gets to the race of creating those fast. And so this is going to exponentially increase the indebtedness levels of those developing countries.
Workers and businesses until a durable exit from the health crisis. We have seen global fiscal actions of 12 trillion.
There you go, 12 trillion. Where does the global fiscal action come from? Well, it's funded by money that was created at the central bank that needs to be repaid plus interest. And new money is being created in order to fund that, when really the government, if they wanted, has full authority to create that money. But instead, they're doing it through the central bank, repaying it plus interest.
Central banks have expanded balance sheets by 7.5 trillion. These synchronized measures have prevented the destructive macro-financial feedback we saw in previous crises. But almost all countries are still hurting, especially emerging market and developing economies. And while the global banking system entered the crisis with high capital and liquidity buffers,
the global banking system entered with high liquidity and buffers because they sold all the toxic assets to you through taxpayers' money and bailout schemes, and then they sold them to your pension by getting companies in Wall Street like Standard & Poor's and Moody's to class AAA ratings on toxic assets that were mortgages that were packaged together through the retail banks, creating brand new money every time they issue a loan, repackaging it through the investment bank, and then selling it to the buy side so that you ended up with the bags in your pension.
There is a weak tail of banks in many emerging markets. We must take measures to prevent the buildup of financial risks over the medium term.
Right, now we're getting ready to prepare the world for risks within the banking system. So prior to this, we had a health crisis that led to an economic crisis, but it hasn't touched any of the financial markets because they decided to move to socialist markets, i.e. the Federal Reserve and the government saying stock markets are not allowed to crash, assets are not allowed to deflate, the rich that have accumulated all these assets are not allowed to lose any money, those that own all the real estate and property are not allowed to have the prices become more affordable so that other people can start accumulating those assets. Instead, we have to actually prop up the markets.
We face what I have called a long ascent for the global economy, a climb that will be difficult, uneven, uncertain, and prone to setbacks.
So we're getting ready to warn the world that we've put as much of our monetary policy as we can into propping up these markets. There might be volatility, there might be turbulence ahead. And rather than actually saying that the world needs some deflation because of all these asset prices that have been continually increasing, creating a ginormous rich-poor divide, rather than letting those correct, we need to start warning people that there might be trouble in the banking system, because now the financial crisis is what I think they're trying to prevent, or they're trying to warn people that in order to prevent that financial crisis, we need a monetary renegotiation. For those of you that have been watching my YouTube channel and have stayed subscribed, you'll be very familiar with these terms because you knew it was coming.
But it is a climb up, and we will have a chance to address some persistent problems: low productivity, slow growth, high inequalities, a looming climate crisis.
And these, the low productivity, low growth is the real issue. You can't stimulate productivity. You can't do it through monetary policy because it's no longer working. You just end up with crony capitalism, where people end up that are most connected to these IMF, World Bank organizations and central banks end up with all the cheap debt so that they can then make the markups and pass on those debts to the people that are the poorest that pay the highest interest rate of 30, 40, 50, 60% upwards. So that is not going to touch inequality. And yes, we do need to address inequality, but it's not going to be addressed through more debt, through more stimulus. It's going to have to be addressed by actually returning the markets to some kind of normality and allowing the markets to prevail, or moving to what this ends up with, which is continuing the same as usual, a higher and higher degree of socialism until you end up with some of the outcomes I talked about in the book, Bank to the Future, Protect Your Future Before Governments Go Bust, such as 100% tax and radical monetary reforms.
We can do better than build back the pre-pandemic world. We can
totally agree, but will you do the monetary reforms? This is the moment to actually determine whether we do monetary reforms that actually solve some of these issues, or we repackage it in order to maintain the status quo. Either way, big changes ahead, big changes to financial markets, big changes to banking, big changes to the global financial system is what we need to see. And I want to make sure that you're on the right side of that, because there's several eventualities you'll need to be prepared for.
Can build forward to a world that is more resilient, sustainable, and inclusive. We must seize this new Bretton Woods moment. How? I see three imperatives. First, the right economic policies. What was true at Bretton Woods remains true today.
Which means that we're moving to greater in levels of Keynesian economics. But I don't want to pain this. I don't want to push this all on Keynes, because Keynesian economics has never been followed since Bretton Woods. What Keynes wanted was the Bancor currency, was the issuance of a new currency between various different policies that came from that. But he didn't get that. In the end, the US managed to negotiate itself to be the world reserve currency. And we've been playing those trends ever since. And then they reneged on that negotiation in 1971 through the Nixon shock. So what I think we're hinting at here is more of the same: higher taxes, higher government interference, central bank digital currencies that are going to be introduced in order to stimulate some of these economic policies that these organizations feel need to be done on a global scale with global currencies that are going to have so much impact on our personal freedoms, liberties, and sovereignty.
Prudent macroeconomic policies and strong institutions are critical for growth, for jobs, for improved living.
So they're basically hinting at that monetary policy no longer works, it's no longer effective, and we need to see more and more fiscal stimulus, which means governments need to spend more, which means that you need to pay more in taxes.
Standards. One size does not fit all. Policies must be tailored to individual country needs.
Agreed. This is why one of the really interesting things where we had with those that are in countries in Europe is the reliance that they now have on the European Central Bank, because they gave away their freedoms by adopting the euro. They gave away monetary policy to Germany by adopting the euro. Britain, interestingly, didn't adopt the euro, but they still exited through the Brexit. Might end up being a good situation. But this is all about the people having more control of their own currencies. But the hypocrisy of all of this is the IMF doesn't want people to have more control over their currencies. They want the adoption of the central bank digital currency that they tried to introduce. It was originally the special drawing rights. That was a failed experiment. So now they're starting to see all of these central banks around the world starting to explore issuing their own central bank digital currencies. And the IMF wants to make sure that we have this one global digital currency that essentially can roll over and bail out some of the less powerful central banks that are following US policy of taking all of these toxic assets on their balance sheets.
Support remains essential for some time. Withdrawing it too early risks grave and unwarranted economic harm. The stage of the crisis will determine the appropriate shape of this support, generally broader early on and more targeted as countries begin to recover. Strong medium-term frameworks for monetary, fiscal, and financial policies, as well as reforms to boost trade, competitiveness, and productivity, can help create confidence for policy action now.
So what I'd like to see here in boosting competitiveness is a pro-Bitcoin policy, a policy of allowing currencies to compete, and then the people having choice. Whether we'll get that will be another thing, because I think this is going to be more consolidation of power, more consolidation of currencies, and the removal of, or even an anti-competitive behavior is what I would expect to see here, as opposed to stimulating competition and innovation that we're seeing in the financial markets right now, as we start to get currencies like Bitcoin that exist without the need for any of these central authorities,
while building much needed resilience for the future. That includes keeping a careful watch on risks presented by elevated debt. We expect 2021 debt levels to go up significantly.
And they'll go up a lot more if anyone takes on those IMF loans as a result of them being created as debt so that they can be repackaged into these organizations.
To around 125% of GDP in advanced economies, 65% of GDP in emerging markets, and 50% of GDP in low-income countries. The fund is providing debt relief to its poorest members, and with the World Bank.
Relief is a very misleading word. They're providing loans with tied agreements that comes with terms and conditions that remove the sovereignty by having to spend that money in more developed nations.
We support extension by the G20 of the debt service suspension initiative. Beyond this, where debt is unsustainable, it should be restructured without delay.
Restructuring without delay means that those that have invested in these products, those that are savers, will actually end up getting the wrong side of this. So those with the debt have bad debt. Those with the savings that have actually been investing in these products end up being screwed. So it all depends on how, there's a winner and a loser in any of these. Now, the vast majority of the world have been pushing debt-based, but this will also punish savers. Why? Because they don't want the world saving. They want you to take on more debt so that private banks can create more money every time they issue a loan, and they can leech interest off the economy that is backed up by a hidden tax called inflation through the central banking system.
We should move towards greater debt transparency and enhanced creditor coordination.
Well, we're already seeing a lot of that with collateralized loans in the crypto markets. So that's a trend that's actually happening, and greater debt transparency. But I don't think that they're central bank digital currencies. They're not going to suddenly be created on blockchains. And if they are, they're going to be databases that are packaged up as blockchains, pretending to be more transparent and supporting that.
I'm encouraged by the G20 discussions on a common framework for sovereign debt resolution, as well as on our call for improving the architecture for sovereign debt resolution, including private sector participation.
So I do think as an investor, you need to start thinking about what the implications of these debt restructurings are actually going to be. When I cover the 4-part video series, retirementplanb.com, we'll actually be going through how to position yourself for the different likely outcomes as a result of this.
We are there for our member countries, supporting their policies. And policies,
i.e., you can borrow some money off us and it will come with tied loans,
must be for people. My second imperative. To reap the full benefits of sound economic policy, we must invest more in people. That means protecting the vulnerable.
Invest is code word for lending to countries so that then they can support and cripple them with debt.
It also means boosting human and physical capital to underpin growth and resilience. COVID-19 has underscored the importance of strong health systems. Rising inequality and rapid technological change demands strong education and training systems to increase opportunity and reduce disparities. Accelerating gender equality can be a global game changer. For the most unequal countries, closing the gender gap could increase GDP by an average of 35%. And investing in our young people is investing in our future.
So these are all markets that they want to push these loans onto. So you've got to remember, these are not stimuluses, these are not help, these are markets to push debt onto.
They need access to health and education, and also access to the internet, because that gives them access to the digital economy, so critical for growth and development in the future.
And what we need for all of this is the IMF central bank digital currency so that all these loans can be issued and they can be repaid plus interest in a currency that's not your domestic currency, that your central bank can't control the supply of, that we can control the supply of.
Future. Expanding internet access in sub-Saharan Africa just by 10% of the population could increase real per capita GDP growth by as much as 4 percentage points. Digitalization also helps with financial inclusion as a powerful tool to help overcome poverty.
Agree with all these policies, but doing it through the issuance of a central bank digital currency issued by the IMF, repackaging all of the toxic assets on their central banks, is about losing freedom, losing sovereign rights, all great policies for their own countries to do, but you definitely don't want to be doing that through the IMF help.
Just as the pandemic has shown that we can no longer ignore health precautions, we can no longer afford to ignore climate change.
So this is the point where I'm going to check out, really. I don't want to go too deep into the politics. I'm just going to move back to my face, and hopefully you can see me right now. But I hope that this just gives you an alternative questioning of you deciding what you think is actually going to be happening as a result of this. As I said, the original plan was by John Maynard Keynes was to introduce the Bancor coin. You can check that out as well. Don't confuse that with the cryptocurrency at all. That's essentially a newly created supranational currency that would be used for international trade as a unit of account, whereby you can take your actual gold and exchange it for that currency, but you can't do it the other way around. So it sucks up all of the gold out of the economy and moves it to the new currency that's going to be doing. What we're going to see next, if you've watched my previous videos, is that we're going to see central banks, digital currencies, I believe, issued in proportion to the bad debts as a bank, the opposite of a bank bailout, whereby you're going to have to sign up to an app in order to receive some of the government-free helicopter money, and also sign up and opt in when if your bank goes under some of the stress that they're hinting at in this video, then rather than lose the money because the insurance schemes do not cover the systemic risk events. I covered more about the different types of bank insurance schemes and how they are covering less than 1% of deposits. It's all a movement towards these more global, controllable central bank digital currencies. So a quick recap of what I covered in the last video, just to wrap this off. And then if you would like to join me for an AMA, head over to my YouTube channel, Simon Dixon, and you can ask as many questions as you want. Ask them on this video. We'll return to them when I do the actual AMA and interact. But in the last video, we talked about the bad and the good of these central bank digital currencies. They're not all bad. They're not all good. But what you're going to see with these central bank digital currencies as they start to introduce them is automated negative interest rates. So they can fully discourage you saving and encourage you taking on debt so that more money can be created through the private banking system so that banks can leech off as much interest through that money creation process. You're going to start, rather than letting the banks continue that because we're reaching at the end of the debt cycle, they'll start issuing them directly and allow the banks to go bust. So there are some benefits from that. And it means that you won't lose your deposits is my forecast. I don't think we're going to have those bail-ins like that or bailouts, but I think we are going to see banks come under fire as the next move and moving towards pushing this next central bank digital currencies. You'll see automated tax collection. You'll say automated blacklisting, so that if you spend your money in the wrong way, you contribute to the wrong charities, you don't spend your money on certain things, then those wallets are going to be blacklisted, and automated surveillance built into the applications by design when you download these apps of the central bank digital currencies. In terms of the good they can do, as we said, they can be used as a mechanism for deleveraging the economy, rather than having the system we have right now, whereby money is actually created as debt. They can actually deleverage the economy. They can essentially supply the money without going through the crazy schemes that they have right now, like quantitative easing, where you have to go through debt capital markets, and then the interest rate is factored into that, and it increases the leverage rather than decreases the leverage. You can also see algorithmic monetary policy talking about some of the things that they were talking about, more transparency, At least financial markets could react to the algorithms, but I'm pretty sure that just like in every fiat currency, as soon as they come onto fire, they just change the rules. And you can have a deleveraging through introducing debt-free money. Now, I know that's a lot. I don't want to cover too much in one go, but head over to the YouTube channel, subscribe to the channel. I've got plenty of videos on all of these different topics. But what we're moving towards now is certainly currency wars are coming. Rather than having physical wars, we're starting to see currency wars in a grab for control, in a movement towards the monetary renegotiation, where there'll be some winners, some losers, and you as an investor or a saver have to start thinking about how you can protect the different scenarios that are coming. Really, you can summarize this up in the Tiffin Dilemma. The Tiffin Dilemma is essentially the problem that we've seen with the European Central Bank. It's where domestic policy can have harmful effects on global policy, just like we're seeing with the Federal Reserve US dollar standard that we moved to during this Bretton Woods negotiation, whereby US has essentially moved greater and greater into a power play, where we move to the point now where 70% of currency is dollars and 50% of all transactions happen in dollars. And therefore, you and your savings want to hold those in dollars, but you have all the hidden effects of the power of the Federal Reserve being able to issue that and the expense that has on other countries as well. So the Tiffin Dilemma is probably one thing you want to start looking at, because there will be big winners. The IMF wants to win it. The World Bank wants to win it. The Federal Reserve wants to keep what it's got. And there'll be lots of other different smaller central banks that can make asymmetric bets in order to rejig their power play. Most of the people that will get a seat at the table at this Bretton Woods renegotiation, I believe, will be those that hold the most amount of gold on their central bank balance sheet and in their countries compared to the GDP and growth that they're actually doing. So I think the big players in this are going to be America, it's going to be Russia, it's going to be China, and it's going to be Germany representing Europe, and then a bunch of other people and a few central banks that might do something really, really brave and start to diversify some of their reserves by holding some Bitcoin in order to actually start to make an asymmetric bet. So that's what I think is actually coming up next. I know that some of those things sound very, very extreme, but a lot of things that I've said sound extreme, and we're starting to see that many of those things can actually happen. So call to action. I'm not going to do an AMA, but if you would like to ask any questions on this, head over to my YouTube channel, Simon Dixon, hit that subscribe button. Please do like, share if you like this content and you think it's important, because I was going from a very, very small niche audience to more and more people being able to hear these messages and understand some of the things that are actually coming up. That's only possible because of you. So please do like, please do share. And I'd like to see more and more people get hold of this content and start to educate themselves on some of the things. I'll do an AMA next Wednesday on my YouTube channel, Simon Dixon. Hit the bell symbol. YouTube will send you a notification. I'm going to be releasing that 4-part video series on exactly how I'll be investing during what I call the Great Depression of 2020, leading up to the monetary renegotiation. If you want to be first on that list in order to receive a notification about that free 4-part video series, head over to retirementplanb.com. And if you were a Twitter user, you can grab me on @SimonDixonTwit. That's TWITT, @SimonDixonTwit with an X. All of those links should be in the description, in the live chat. Azad will make sure they get there so that we can actually continue this conversation, move over to the AMA. I also want to leave you with one final thought. You are alive at one of the most interesting times in financial history, and some people are going to get hurt from that. Some people are going to do well, and I want to make sure that you at least have the information to decide what side you're on and how you're going to position yourself for that. So it is an exciting time. It is a crazy time, but you've got two ways of looking at it. You either let fear take over you in all of this stuff that's actually coming up, or you decide that you're actually going to position yourself to be on the right side of these trends. The obvious question is, what are those trends? And that's what I'll be covering in all future videos So thank you for your time. Hope you enjoyed this video. This is a huge bombshell. And again, thank you to all my subscribers that have been there all along and have been very, very familiar and expecting many of these things to happen. So peace